Hey, I'm Kerwin.
And this is Jeffrey.
And we are the Donis brothers. Today we're talking about the common mistakes investors make when they first get into real estate. Starting out, Jeffrey, why is it important to just understand what some of the mistakes are in general? Like, what would you say?
Yeah, I mean, it just depends, right? But obviously you want to know what to avoid. And the best way that we've done that in our journey is by learning from other people's mistakes.
Yep, exactly.
So that's kind of why it's important, just to see where you don't necessarily have to fall down.
Yeah, exactly. And I mean, I'm a big fan of learning from other people's mistakes and failures, because why would you want to repeat them if they've already done it? You know, you can leverage their experience, and that's why it's important to have a mentor. We have another video on that as well if you want to check that out. But also in general, there are many mistakes that people typically make, whether it's due to a lack of education or experience. There are a lot of missteps you can make along the way. So we're here to help you avoid them and kind of help you mitigate the risks. And of course, when it comes to investing, there's always risk. But one of the best ways to mitigate risk is through education. So I'm just going to quickly kind of give a brief overview of many of the common mistakes, and then we're going to dive into a few. But first and foremost, I would say the first big mistake is not understanding the deal structure. And some of these are going to be in terms of a passive or limited partner role, and many other of these mistakes will be from the active investor, lead sponsor role.
Yeah,
so there's different mistakes.
Just to clarify, it's in regards to multifamily real estate.
Yes, but a lot of these mistakes can be applied to different types of real estate investing. But for the purposes of this conversation, we're going to tailor them mainly towards multifamily, but a lot of these can apply to any real estate investing. So first, not understand the deal structure. There's different structures when it comes to a multifamily deal. There's Class A, Class B, and Class C properties. So we'll start kind of just by defining what those are. So there's three different types of classes when it comes to real estate properties, specifically in the multifamily space. There's a Class A property, Class B, and Class C. Class A properties typically have lower returns because they're in really good condition and they require minimal renovations. Class B properties have moderate risk and require some renovations and upfront costs. So they're kind of in between Class B. Class B are in between Class A and Class C. Class C and D properties have the most risk and require the most renovations. And that's because there's a higher opportunity for value add. They need the most renovations and most capital to inject it into the property. Exactly. Yeah, the term heavier lift just means there's more work that needs to be done. And so, of course, it makes sense that the more work, the more money you need to invest in the property to improve its condition, the more risk, because there's more chances for it to essentially go wrong, right?
Yep, and there's obviously more upside to those as well.
Exactly. And so I think it also kind of goes to that age-old phrase saying, with more risk comes more reward. You know, more risk, more reward. So value-add investors, typically they do go in to add value to the property through improving the condition or decreasing the operational costs of the property. So when you're investing in a Class A property, you're taking less of a risk than when you're investing in a Class C or D property. But it's important to understand that you also probably receive less of a reward. So you're not going to receive higher returns.
As high returns as you would in, let's say, a Class C value-add deal versus a Class A. Just because also typically the Class A properties are more expensive than the Class C properties, which means that there's less of a return based on the amount of capital that you're putting into it. You're going to get less out of it.
And I know why they're more expensive, but just for anyone in our audience that doesn't know, why?
Well, yeah, just a nicer asset. It's going to be in better condition. Typically, they have better residents there. Yeah. So that's obviously why it's going to be
the same reason a nicer apartment building when you're renting it would be more expensive than a less nice
nicer amenities.
Exactly. And so this kind of goes hand in hand, but the investment strategy is really similar to the class of the property. So there's turnkey investors, distressed property investors, and value add investors are also a third category. So value add investors, of course, like we mentioned, they go in and look to improve the condition of the property, whether that's by improving the condition. They look to improve and increase the net operating income on the property, whether that's through improved condition or decreasing the cost it takes to run the property. And turnkey investors who would typically buy Class A property, they buy a property that's essentially ready to rent out. And so they don't really need to inject or use that much money to improve the condition or do anything like that. So really, this is called turnkey because they're taking it from the previous owner and just renting it out essentially immediately after.
There's just less work to do. Therefore, it's going to be a quicker turnaround. You're going to be able to rent it out a lot quicker than you could if you were to go do a value add now. On the value add deals that we'll do, typically we're doing BC class assets, and they do need some work. It's not something that's completely distressed. We don't look at too big of a lift, so we're not looking at Class D properties, but typically Class B and C that need some type of renovations. Maybe that's on the exterior, interior, maybe the amenities, the playground, the gymnasium if they have a gym, the weight room, whatever it is. We could have some type of value, and that way we can actually go in and get premium rents, which just means you can get higher rents.
Yeah, and so value add, just to kind of build off of that, they do look to force appreciation. So there's two different types of appreciation. There's natural appreciation where the property just increases in value over time, and that's maybe because the market is doing really well and people are moving there, better businesses are moving there, and so it's becoming more of a desirable location. There's maybe less supply, and so more demand creates increased rents, and you can demand more in rent.
Yeah.
So that's natural depreciation. Forced appreciation. Forced appreciation is created essentially by improving the condition of the property or decreasing the operational costs. So I keep chiming on that, but it's important to understand. And then the third category would be distressed properties, and that's when you take a very, very rundown building or a property and you fix it up. It's like the fix and flip. Is that fair to say? Like the fix and flip of multifamily. Do you agree?
Yeah, I mean, I would say the distress is really more so just the kind of condition that the property's in.
Yeah.
But with any fix and flip, I mean, some come in less, worse condition.
Well, I meant like a very rundown building that we've seen in wholesaling.
Yeah. Just think of it as like the worst of the other three classes.
The condition is typically really bad, and that's why it involves the most money to be injected in. And so that's just the kind of like foundational things you should probably understand. And then also as an investor in a deal, if you're a passive investor, you should understand the operational cash flow of the property, which is just the distribution passive investors will receive during the asset's hold period. So that's how much money you're going to be receiving. And that could be quarterly, monthly, even yearly, right? Annually. So the returns from the sale or refinance, if they plan on doing a refinance during the hold period, or if the sale, what are the returns going to be on that? And then also the fees that the lead sponsors are collecting. So these are the lead sponsors are the active investors, the people in charge of the deal. They found it, underwrote it. They're managing the property manager. So those are you want to understand how much they're getting paid.
Yeah, and the fees can vary in different ways. There can be like an acquisition fee.
Yep.
There can be, which is taken in the beginning, right when the property closes. There can be a disposition fee when you sell. There can be a refinance fee if they're able to refinance. Then there can be a fee there. Asset management fee. That's ongoing. So just understanding what that fee is, and just understanding what it is, and then when that'll happen, just to keep that in mind. That'll just help you make an decision before you actually put your money into a deal.
Absolutely. And moving on to our next mistake is not understanding the underwriting. So a lot of investors don't understand the underwriting, whether they're on the active side or passive side. Typically, if you're on the active side and you did the underwriting, you probably understand it.
Yeah, you'd hope you do.
But mainly for passive investors, a lot of times they don't even look at the underwriting, or they just don't know. They are sent it, but they don't really understand it, so they can't know what questions to ask, or they aren't able to identify any red flags if they're there. Trevor, do you have anything to like build off
I would just say, I mean, typically you can ask the sponsor of the deal in regards to what the underwriting is, and just looking at maybe putting it into some simple model that you have. We use a certain model to actually underwrite these properties. You take the trailing 12 and the rent rolls, and then you put that into your analyzer and just see how they came up with their returns, and see if that's something that you agree with.
Yeah.
And it just understanding, you don't necessarily have to do you don't have to understand completely how to underwrite, because that's something that does take time to learn. But if you can at least look at the underwriting and make sense of it, and then if you have any questions or concerns, the sponsor should be able to answer them, and then hopefully that satisfies your needs. Yeah. And if that makes sense, then you're going into that deal a lot more educated and confident that you agree with their underwriting. So I think that's why it's really important to understand it, so that you make sure it's a good investment for yourself.
Absolutely. And just to clarify, underwriting is the framework that investors, they use that to determine projections, to estimate capital expenditure, and to create a business plan for the investment opportunity. And so investors, you guys, if you're a passive investor, you don't have to understand the entire underwriting, like I said, but just a basic understanding is essential to make savvy investment decisions. And so I wanted to kind of list off a few other common mistakes that we've come across in terms of passive investors, that the mistakes that they've made, and that other people have said that they've noticed passive investors making. So not understanding taxes and asset protection. We are not CPAs or tax accountants or anything like that. or tax professionals, but
Yeah.
it's important for you to consult with one before, just so that if in case you have single family rentals and you want to make sure you understand how any other investment, if it's passive or active, how that's going to impact your portfolio. Do you think? Yeah.
No, I think it's like what we always tell our investors is to consult with their CPAs and or tax
Professional, yeah.
tax consultants or whoever they need. Pretty much any third party advisor that they could bring on that can help them make a decision on whether or not this makes sense for them to invest in, and if there's any benefits they can get. Now, obviously, we can tell them all these things, but at the end of the day, they're putting their own capital into the deal. We believe in it, but we want to make sure that they believe in it as well. So that's why we think it's very important for you to work with your own team to make sure that you can come up with your own as little unbiased decision as you can versus just taking like a sponsor's opinion on it.
Yeah. And another mistake, I would say, this is probably more so for active investors, people that are looking for deals themselves and taking them down, underwriting them, learning the ropes. Particularly when they're first starting out, I would say investing by yourself, completely by yourself, it can be a mistake if you do it without the proper education. And that's why we harp on getting a mentor and, leveraging the experience and knowledge of someone else, because if you're investing by yourself, you can make a lot of mistakes, you can lose a lot of money. And with real estate, it moves slow, it's a good thing, because you can overcome like quick emotional reactions in the market if it dips. I mean, real estate, it takes some time to adjust, so that's a good thing. But it's also a bad thing if you get stuck with a bad property. It's really hard to get rid of it, So that's why you want to make sure you're leveraging the relationships that you're making at these conferences that you're attending. Hopefully, if you have listened to us talk about networking. But yeah, do you have any other thing to add about why maybe people shouldn't invest by themselves when they're first starting out?
Well, I just think for us, that's what we obviously started somewhat investing by ourselves, but I honestly know we really always had someone in our back corner or a mentor who knew more than we did, and we still do. And I think that just limits the amount of mistakes that you're going to do. It's going to save you money. It'll save you time. It cut our learning curve by a lot. So literally, something that probably would have taken us years to learn, we learned in a few weeks. And that's just because you have someone in your corner that's giving you all these things, that's helping you kind of maneuver past the obstacles that they had to overcome and learn how to overcome. So for me, I think finding a mentor is the thing that everyone should do. Obviously, you might not have the money to pay for one, but that's what we're so big on going to networking events, because you don't have to pay all the time for a mentor. You can find another way to bring them value. So I won't harp too much on it, but yeah, that's what I think.
Yeah, and so something else we've seen this a lot. And I think there's two schools of thought in real estate when it comes to this, but we tend to focus on this side. So a mistake I would say, and this is an argument, if you disagree, let us know, but trying to predict future appreciation and investing based on future appreciation, that is natural appreciation, not forced. So you're assuming it's going up, you're going to invest there because you think it'll be worth more in the future, just naturally. That, I think, is a mistake, and you're not investing on cash flow. A lot of people that I've met are buying properties that are negative cash flowing, meaning that they're paying every month instead of not putting money in their pocket every month. And Robert Kiyosaki defines an asset as something that puts money in your pocket every month. A liability is something that takes money out of your pocket every month. So they essentially bought a property that is a liability and is not. It should be cash flowing.
Yeah, and the reason that I agree with it, obviously you can try to become very familiar with certain markets that you can predict. It's really a prediction. What we like to call it is speculative. Being speculative, which just means not really there's no way to actually guarantee that it's going to go up. And let's say that it does go down, then how are you going to be able to? Are you going to be able to cover your debt? Are you still going to be making money? Is this going to be a bad investment if it goes down and if it doesn't go up? Because there's no real way to guarantee that it goes up. So that's why we say to invest based on cash flow. And then the thing that you can put on the cherry on top is investing in a good market that you most likely think will appreciate. That's really how we approach all of our investments. We don't base our investments on appreciation. We do obviously like that. It's a great thing, but we base it on how much does it cash flow? Does it cash flow from day one? If the worst case were to happen, are we still going to be able to cash flow? Especially if you definitely don't want to do an investment if you're going in day one and it's not cash flowing, in my opinion. That's just how we base our investment philosophy. But like Kerwin said, if you disagree, please let us know in the comment section down below. I'd love to.
Yeah, we're not going to act like we know everything. So if you guys have an argument, we'd love to hear it. But all of our mentors and a lot of smart people will say that you shouldn't invest assuming it's going to appreciate, and that be your main investment philosophy. And like that's the way you're going to profit off the deal. Like Jeffrey said, it should be the cherry on top. It should not be the main reason that you're interested in that investment opportunity. Too many people have been burned, and we're not interested in losing money in that way. So yeah. Moving on, underestimating the costs and the expenses is another common mistake investors make. So a lot of times they'll maybe just be not conservative enough and not include enough of capital expenditure of a capital expenditure budget, which is essentially the money you allocate for things like expenses and things like that. Because a lot of times, but expenses can come up, unexpected expenses can come up, and if it's up to like I don't know a certain amount of money, and it's over your budget, then you might have to go back to your investors and ask for more, or you're just not going to come out of pocket, or you just won't be able to cover it. Yeah, or it's going to lower the returns if you're raising money. One thing that we do that I think we do pretty well that I'm actually wearing, the construction company we use is called Heritage, and they do a great job. So what you can do if you don't really understand construction, or maybe you're a newer investor and you just obviously don't have that experience, what you can do is build a really good team behind you that knows more, and maybe you can use them as a consultant, or they can actually do the work themselves. But what they're going to help you do is get you accurate estimates as to how much work whatever property you're buying will need, and that way you don't have to go back. And one thing that we always do is we also will be very conservative. So we'll assume that we're going to need to do even more work than we actually think we'll need to do, and that way, if worst case, you have it covered, but best case, you didn't even need to use the money. Therefore, you can either return it back to your investors and increase the returns, or just for the future, keep it there as a reserve so that if something else comes up, you have the money to cover it. So that's why it's so important to have reserves, to have a really good team, and really good people on your side that can give you that information, especially if you're new. Absolutely. I 100% agree. And so kind of to build off of that, due diligence, I don't know if you defined what due diligence was. Due diligence is like on a single family property. It's very similar to a larger asset, like a multifamily apartment complex, but you're going in typically after you put it under contract, and you have like a set time, maybe 30 to 45 days to go and inspect the property to confirm that it's in the condition that the seller told you it was in. And what we do is we'll actually take this company Heritage with us, and we'll walk each and every unit. We'll look at every single thing, whether that's the floor, the bathroom, everything, and make sure that we understand what we're buying. We understand the condition that every single part of that property is in, and how much we'll think it will cost. So that way we understand that, okay, we'll go back to our underwriting after doing due diligence to confirm our initial underwriting and estimates as to what it was going to take in repairs. And that way we're not going to buy something that just won't make financial sense for us. So that's why the due diligence period is there. Yeah, you want to make sure that your underwriting aligns with the reality of the condition of the property. Yep. A lot of people, or not a lot, but I would say some investors will neglect the due diligence or rush into buying the deal. And it's very exciting when you find a deal and you get it under contract. I mean, it can be very exciting, and you want it to make it work. But if it's not in the condition that your underwriting details that it's in, and then it doesn't make sense afterward, it's just really important to do that thorough due diligence. That's why we have Heritage, and you can have a construction company in general, just any company that you have maybe vetted yourself or someone in your network has recommended. That's what we do. That's why it's so important for us, because it helps you mitigate risk. It's all about mitigating risk. So in general, also, I touched on this earlier, but when you don't budget for unexpected expenses, that's an issue as well. So a common mistake that people do, and I've heard, I can't remember which investor said this, but it was an investor that said one of the most important things that they learned during an economic downturn was to have a lot of liquid capital on hand. Trump said, you don't learn a lot from the good times, but in the bad times, he learned. The one thing you want to have is dry powder. Exactly. So we it's important to have that cash reserves. You want to have the money on hand, because unexpected expenses are going to come up at some point. I mean, hopefully they don't, but you want to plan for a bad day. And if you do that, you're able to mitigate more risk. You have that on hand, so you don't have to go back to your investors, come out of pocket, or just really panic when you don't have the money. So that's why it's so important to just have cash reserves. Plan for a bad day, and in worst case, you don't need it. Right. So in general, also, this is mainly for our syndicators and people that are raising money. If you wait too long to start talking to your investors about an opportunity, then you're going to be rushing to get it to the finish line, rushing to get them in, and no one likes a desperate lead sponsor. So no one's going to invest with someone who's pushing them, putting too much pressure on them, and that's what's going to happen if you wait too long. you agree with that?
Yeah, no, I agree. I think just having them understand that these, at the end of the day, you have to understand that you're giving them an opportunity. So really keeping that frame of mind. And you don't want to come off as desperate, but like I said, no one likes to get that energy. They're going to want to work with people that they know doesn't necessarily need them to invest. That will just attract them more. So just understanding the timeline of things. You don't want to rush it. Maybe starting as soon as the LOI gets accepted, or just keeping the investors updated on you submitting an LOI if you think you're going to win it. Personally, I would say wait until after the LOI gets accepted, and then you can let your investors know. Maybe don't give them all the information, but just kind of pique their interest. And then at that point, once you're seeing that it's going to progress and potentially get under contract, that's when you can actually start sending more information and eventually, obviously, start the raise.
Yep. And the last mistake that we've seen investors make is not researching the market they're investing in. And, of course, you might hear about a certain market, or you might live in a market and think, oh, this is good. And I see a lot of development. And while having that, that firsthand experience in the market is good, it's still important to look at the economic trends. Is there employment? Is there high unemployment? What's the crime like? Are there any major businesses coming? Are there any major anchors in the market, like a hospital, universities, things like that make it, that will suggest a strong demand for the type of asset or housing that you're providing. If it's multifamily, or if it's another type of real estate asset, is there a lot of demand there? And Grant Cardone and many investors harp on the importance of location. And on our podcast, we've interviewed multiple investors who've said that even during economic downturns, the strength of the market they were investing in, because of it, they were still able to produce, whether it was just kind of like plateauing returns or increasing to meet their projected returns. So I think that's why it's so important to make sure you're investing in a good location, because that will help you mitigate the impact of an economic downturn if it were to occur during the whole period of that asset.
Yeah, and to kind of go off of that, a lot of investors, one thing that they might not do is look at the crime on the certain submarket that your potential investment is located in. So it's easy to go on just and find local crime rates or what's going on in that area, and specifically the property you're investing in. Maybe there was something that happened the year before, and it's okay if it did. You just want to understand that, one, the sponsorship team is aware of it, which they have to be, because when they go to the lender literally will ask them about it. But two, to make sure that they have some type of plan on how they're going to prevent it from happening, or what's their approach on it. So that's something that I definitely would just keep in mind.
Yeah, and I mean, it's not necessarily, it is a bad thing if there's a lot of crime. I mean, because not only are you bringing people in to your property, and you might be liable if something happens, you should always consult with an attorney. But
it's like bad, but obviously this is why there's value needed.
Exactly. I just think it's important to understand the scope of the project, essentially. Like, what are you going to have to deal with when you become the owner? So you want to make sure you have a full understanding of it. Yeah,
because a lot of our people that we've met have taken over properties that there was a shooting the year before or something like that. But obviously this may not happen all the time, 1, 2, but if it did, that's their business plan, is to go in there, improve the property, and as well as maybe improve the types of people that are living in the property, and that will obviously hopefully decrease the amount of crime at the property. So that's kind of how you can add value. Now, it just depends on who the sponsor is and if that's the business plan, and if you as an investor are interested in something like that. But definitely something to keep in mind.
Yep. And so if you guys have any comments about this episode, or if you disagree with what we said about investing for appreciation, just anything that you have about this episode, let us know. We'd love to hear your feedback. And if you guys have any other topics that we mentioned today that you'd want us to expand on, please share it down below in the comment section. If you enjoyed this episode, please make sure you subscribe and share it with your friends and like. And where can they find us, Jeff?
Yeah, at Donis Brothers on all social media platforms. www.donisinvestmentgroup.com is our website. You can listen to our podcast, The Real Estate Monopoly, on all podcast aggregators. You can follow me at Jeffrey Donis, and on any platform, you can follow Kerwin
at Donis Kerwin on Instagram. And if you guys want to check out our 5 common mistakes passive investors make playbook, then it's donisinvestmentgroup.com/playbook. Check it out. And if you guys want to just hit us up, DM us on Instagram. We'd love to chat with you guys and see what episodes you guys want us to talk about, what topics, if you want to have a conversation, let us know. Just hit us up.
For sure. We appreciate everyone's time.
Let's take action. Get out there.